Energy stocks are among the best performing as we're taking a look at the price of oil. It had advanced above $87 per barrel. It's pulling back from that, but certainly it's been on a tremendous rise from those December lows. Recently getting an extra kick as we see escalations of tensions in the Middle East. And it's taking our TSX energy sector along for the ride. The TSX energy sector now trading at the highest level since June 2022. When you look at simply the oil producers, this strips out the pipelines, which struggle in a rate environment that's elevated, and just look at the producers. The TSX oil producing index is now trading at a 10-year high. So we are seeing these breakouts in these stocks as a result of higher oil prices. Let's bring in Cole Smead, portfolio manager and CEO at Smead Capital. Cole, thanks so much for joining me. As you put dollars to work, is it kind of all gravy? You're looking at the sector and allocating to producers, services, refiners, or are you starting to get selective as we move ever higher in the crude price?
Yeah, and thanks for having me. So we're just being really lazy. We like the businesses we own. I think as I put in my notes up there in Canada, we own MEG. It's fighting out for our largest position in our portfolio for our international equity portfolios, which is our ex-US. And then we own Cenovus as well. We've been a buyer of Strathcona here in the last 6 months as they've been putting together their public company as we know it today, and then own a smaller position in Whitecap. So we've been very lethargic, taking some opportunity to buy into some of those here over the last 6 months. But I just say it because I think the dumbest thing I've seen recently is watching people try to trade around these names. Oh, I think I'm going to call a near-term top, and then I sell it and try to buy it back lower. And then they wake up to this rally that they didn't expect. So I think patience is the name of the game. I think staying very aggressive. And I think this is really a good Canadian market. I mean, having $10 pick up on WTI usually passes pretty straight through to WCS spreads. And therefore, this is a huge torque model for these Canadian producers that are going from $62 to $72 on WCS.
It's interesting that you are advising that you move away from trading because certainly thinking about commodities as a set it and forget it, it can be difficult because, yes, crude is working now, but what if we get a strategic petroleum reserve release? What if a ceasefire happens in the next month or two? Isn't there a significant downside risk?
No, and the reason why is because North America has been producing flowing barrels at a rate that they can't sustain. And I say that because, this is partly a Canadian issue, but I would say it's really an American issue, where the Permian will not be producing the same flowing barrels in 2 years. The reason why the Saudis continue to cut and feel fine in that is because they're going to call the Americans bluff. The bluff is that they continue to produce at this level. The Saudis don't think they can. I think the Saudis are right. So when you hear like Vicky Holub, the CEO of Occidental Petroleum, talk about 2025, there's a line in the sand. She's pointing out that she thinks they will be able to continue to produce, but not everyone. And the Permian is the field that will not be producing that same level because it's really American production is the Permian ultimately. So we see a tightening supply world over the next 2 years. And therefore, what that's going to do is finally incent supply to pick up. But again, that's going to be at higher prices. I mean, here we are, with this nice $10 plus move, and you're not seeing big announcements for people to go out and produce more and CapEx new assets. What Canada really has on its side is reserve life. So, for example, Strathcona came out more recently and said, here's what our reserve life is. And they were letting the street know, hey, we think we have really good assets. And what that's done is the stock has responded to that as not only oil prices have moved up, but their forthright communication to their investors in the street has really worked to their advantage. So we think this is a great era. I think everyone that doesn't own oil stocks is being foolish. To your guest point a second ago, I think everyone over-owning American tech companies is an idiot. And there's just a big chasm between those two worlds right now.
I wish you would tell us how you really felt, Cole. I love the unvarnished opinions there. I just want to pick up on a point. You said the U.S. oil production can't sustain at these levels. Why not?
Yeah, two reasons. One, the rock, or what I'll call the reserves, they have shorter life assets, so the reinvestment cycle is nearer. But then beyond the reserve or kind of the rock issue is who's got the CapEx spend to go out and greatly increase their flowing barrels or maintain the existing. We've done a pretty good job in the United States of continuing flowing barrels with marginal CapEx, but the cycle has got to turn. Go look at the servicers. They're not making much money because no one's done big projects. And so I say that because if you look past shorter cycle assets like America, you're going to longer dated assets like Canada or offshore projects, okay? And there's kind of the talk of Guyana and Suriname and what they could bring. I think that's a pretty good picture of where long-term supply will have to increase, because the companies right now don't want to scare away their shareholders. They are fearful that if they scare shareholders away in big CapEx projects, their shareholders will never come back. One thing I will add, I'm very disappointed that the Canadian majors aren't consolidating the industry up north of the border. They should be. It's a world right now where they should be going and finding Austin Powers mojo and in their boardroom with the banker and going out and using that mojo, buying companies. That's not going on. I think that's foolish too. And this is a good environment if we're going to have tight markets for the next 2 to 3 years like it looks to us.
That's interesting, because it seemed like the push was, don't do that. Take the money you have and return it to shareholders in dividends and buybacks. So why do you think they should go out and do acquisitions? Because it hasn't always worked out in this sector.
Yeah, well, you got to remember, when it didn't work out was when everyone was excited about energy in the 2010s. Now everyone's been trying to figure out why they should be bullish on energy. Many people have missed this entire move to this point. And you're in a world where all stock deals can be very attractive. So this is not where you got to put up a bunch of cash and debt. Debt is a lot more expensive for Canadian producers. So an all stock deal, use the Strathcona model. They've communicated they're going to go out and do stock deals to acquire assets, and then they'll return capital to shareholders. I think that's a very good model, because if you can use your stock as an asset to acquire someone's asset at a cheaper multiple than your own stock price is being valued, congratulations, that's an accretive acquisition. The reason why people often mock that is because usually deals get done at the top. And as I'm advocating, this is not the top. This is not as good as it gets. I think we got to be somewhere north of 120 to maybe 150 to really top out enthusiasm in this space on WTI.
Because you invest internationally, I'd love to get your view on the valuations of Canadian producers, which can trade cheaper than international peers, and whether you think that's still warranted.
Well, so most of the international peers, like you use the European majors, those are very scalable businesses. They historically have very attractive costs of financing, and so that's why they normally, with their liquidity, get better multiples. Okay, now that's if you want to be a passive index or a really boring stock picker who wants to take risk in this space like a chicken would. Our goal, and what we're trying to do for our investors, is we're trying to produce wealth. And a lot of wealth, because we got a benchmark we got to beat, and we have certain things we got to meet for those folks. We're trying to create wealth. So you're trying to ascertain where are the most attractive risk-reward relationships, because to your point, there's no guarantee you're going to be right. But if you're right, you should get paid a lot for taking that risk. And that's why we don't sit in a lot of those major producers, because the risk-reward relationship is skewed to the upside because of the fundamentals of oil. But if you're right about oil, you're not going to make very good money compared to other places. So, on the Canadian side, like I said, we own MEG, we own Strathcona. We think those are great risk-reward relationships. Even Cenovus as a major, I think, is better than the other majors. But then on the U.S. side, I mean, I know you guys probably still consider Ovintiv a Canadian name, but I think of like Ovintiv on the U.S. and Canadian world, Apache. They're better risk-reward relationships for an environment where tight supply will reward people that can produce supply.
No, I think we